How's it going, everyone? It's Isaiah, the Texas loan officer, here again to go over with you what happened yesterday when the Feds cut the rates. So yesterday, the Feds cut the rates by 1/4 of a point, or 0.25%. This dictates how money moves from bank to bank, and it's the lowest benchmark it's been since November of 22. Loan the rate means cheaper loans, but that's not always going to be the case. That means if you have a high-yielding savings account, you're going to see that price go down. So for example, if you had a high-yield savings account at 4%, you may see it dwindle down to 3.75% on your savings. A high-yield savings account, or HYSA, the savings account that offers significantly higher interest rates, known as annual percentage yield, or your APY, than a traditional savings account. These accounts are often provided by online banks, which have lower overhead costs and are FDIC assured. Essentially what this means is the return on investment for the government borrowing your money. Well, their job is to enhance employment and stability. That means mortgage rates are more on the long-term rates, not the short-term, like what happened yesterday. So mortgage rates are more dependent on the long-term and not the short-term gain. So that's going to be the 10-year yield. Following the 10-year yield when it comes to mortgage rates is a good proxy because the average homeowner holds their home for 10 years. So mortgage rates tend to increase whenever they cut the rates because investors typically anticipate higher inflation and federal deficits. Now, that's not to say that mortgage rates are the exact same thing as 10-year yield. You have what we call the spread. The spread is the basic cost of doing business. So in this case, the cost of doing business is the risk that this investor takes on for taking on that mortgage. These investors also demand some kind of premium for taking on the risk and taking on this mortgage. So whenever we talk about mortgage rates and we see the Federal Reserve cut the rates, we may not even see the mortgage rates decrease. Instead, they may increase and stay there. They may stabilize, we don't know. It could take weeks, months, or if even years for us to see the results. One thing to think about as well too, is if rates on the houses go down, what do you think happens to the purchase price of that house? Of course, it's going to, with lower rates, there's more demand for homes, but now it's a seller's. If you have any questions pertaining to this or anything else real estate related, please feel free to reach out to me. Please like, subscribe, and share this video. I'll talk to you guys soon.